This is Hilton Hotels at Embassy Manyata Business Park, Bengaluru. Now imagine if you could own, not stay, but own a particular room in this hotel, and whenever a guest comes to stay in that room, Hilton Hotel pays you for the time the guest spends in that room. Sounds a bit odd? Well, what I just said can actually happen not in a direct manner, but in an indirect manner, thanks to something that is known as REITs, or real estate investment trusts. Now, if I rewind a few years, it required a significant amount of money for someone to invest in real estate, and it was quite a hassle thanks to a lot of paperwork that was required. Hence, real estate as an asset class was something everyone could not afford to invest in. But things have changed now. REIT, in simple words, is a way for common people like you and me to invest in real estate, and that too at a significantly lower amount of money. They operate and invest in real estate properties, and they are publicly listed as well, which means they are available on the National Stock Exchange. And what that means is you and I can purchase the shares of these publicly listed REITs. REIT works similar to a mutual fund, wherein they collect amount from a pool of people, and after they have collected that amount, they invest that in various commercial real estate properties. So ideally, you get to own a part of a real estate property which represents whatever small amount that you have decided to invest. Hence, you can now own one room of Hilton. Okay, even one room would be quite expensive. Let's say a closet in that particular room. Anyways, kidding aside, let's see what are the options available for you if you want to invest in REIT in India. As of now, there are 3 REITs present in India: Brookfield's India Real Estate Trust, Embassy Office Parks, and Mindspace Business Parks. So basically there is an entity which is the REIT, which in this case, let's say it's Embassy Office Parks, and this REIT has investments in Hilton, which I showed earlier. Now what happens is when you're purchasing shares of Embassy Office Parks REIT, indirectly you end up owning Hilton as well, because Embassy Office Parks has investments in Hilton and it maintains Hilton. So that's how it actually works when you're purchasing any of these REITs. And one thing that I would like to mention is it's not just that they have an investment in real estate, because different companies can have different investments in various places. REITs is a trust, and they are mandated to invest at least 80% of the value of their total assets in real estate properties which are complete or which are income generating. So one unit of Embassy Office Parks is currently trading in the stock exchange at around rupees 360, and the other 2 REITs that I mentioned, their shares are also trading between rupees 330 and 380. So you can see you can start investing in real estate with as low as rupees 330 and end up owning maybe 50 bricks in a building. Okay, so how do you earn when you are investing in a REIT? You see, for a company to qualify as a REIT, there are various criteria. One which I mentioned earlier regarding the 80% investment that has to be made. And another one is 90% of the income that a REIT makes that has to be distributed back to the unit holders, that is you and I, when we invest in that REIT. So in order to understand our income, let's first understand how a REIT earns its own income. Now the way REITs work is they obviously invest and own real estate property by themselves, but they also have something that is known as SPVs, or special purpose vehicles. Now without going into much details, the REITs have a controlling interest, or they own these SPVs, and they normally invest in real estate properties through the SPV. Now, when it comes to the REITs themselves, their income can normally be broadly categorized into 5 areas. First, we have an interest income. So normally, apart from the mandated 80% investment which I mentioned earlier, from the remaining 20%, amongst many other things, REITs are allowed to invest in fixed income instruments, and any interest that they earn from those instruments, those fall under interest income. Number 2, we have rental income. Obviously, for the properties that the REITs own, they receive rents from those properties, and those fall under rental income. Number 3, we have dividend income. This is received against the equity share capital that they own in the special purpose vehicles. Number 4, we have repayment of debt, or in financial documents, you would normally see this as amortization of SPV debt. This is nothing but REITs provide loans to the SPVs as well, and when the SPVs repay back those loans along with interest, they fall under this category. And the last head that we have, that's capital gains. So if any REIT sells any property and makes a profit, that obviously would be categorized as a capital gain. Now, when it comes to the income that we earn from the REITs against our investment, 3 particular components form parts of that income. So in this case, if we see an official document that is released by the Embassy Office Parks REIT for the quarter ended 2022, we can see the distribution that they made for this particular quarter. It has a mix of interest, amortization of SPV debt, and dividend. So these are the 3 components which formed part of their distribution for this particular quarter. So this is the total income that Embassy Office Parks distributed back to its unit holders for this particular quarter. And this distribution of income back to the unit holders is done by the REITs normally on a quarterly basis. And after every distribution, the REITs would also release the mix or the components that form part of that distribution for that particular quarter, like the one which you're currently seeing now. But there is also a fourth component through which you earn when you invest in REIT, that is capital appreciation. So currently one share of Embassy REIT is trading at Rs 358, and if after 1 year the value of that one unit becomes 390, then the value of your investment has obviously increased, and that will form part of your income when you sell off that unit. So that's how this also forms part of your income that you would make from a REIT. Now if I talk about the average annual return that you can expect to make if you invest in a REIT, if I go to ticker tape and I select Embassy Office REITs, you can see for a 5-year period it has given an average annual return of around 12%. And if I talk about the other two REITs, that's Mindspace and Brookfield, both of them gave a return in the range of around 21 to 22% per annum. So that's quite good, but this obviously forms part of the capital appreciation aspect of income that I talked about earlier, and this is dependent on obviously the movement in the unit price of the REIT. So after a period of 1 year, that price might fall, so your return might become negative, and it might also go up and you can get a positive return as well. But if I talk about the other three aspects, the interest, dividend and amortization of SPV debt, if I combine these three, it can be seen that the REITs have given a gross distribution yield of around 5.8 to 6.3%. So this is what you can expect to make if you invest in a REIT. Now obviously the gross distribution yield is kind of an active income because you're receiving that on a quarterly basis. And the fourth part, that's the capital appreciation, that's a passive sort of income because that will only happen to you if you sell your units. So that's how it works when you're investing in a REIT. Now when it comes to taxation, quickly I want to discuss what would happen for these four components. For the interest income, that will be taxable as per your income tax slab. In dividend, there is a criteria wherein the SPV, if they opt for a tax concession, the dividend that you would get will be taxable in your hands. But if the SPV does not opt for a tax concession from the government, the dividend that you would get would be completely tax exempt. In India, for the three REITs that we have currently, the dividend that you would get from them will be completely tax exempt. So would be the amortization of debt. And the fourth part, that's the capital appreciation part. Obviously, capital gains tax will be applicable in that case, similar to what it is if you are investing in an equity share as well. So that's how the taxation aspect works when you are investing in REIT. Now, the reason I think you should consider investing in this particular asset class is, number one, India has a huge potential for growth in the upcoming years, and real estate will obviously form part of that growth story. It is in fact estimated that the market size of real estate would grow by 5 times by 2030, and with the introduction of even more REITs, this is expected to improve. But two, like I mentioned earlier, REITs are mandated to distribute 90% of their income back to the unit holders, so you don't have any worries there. You can keep earning whatever the REIT earns. Number three, again, it's mandated by law that REITs have to invest at least 80% of the value of their total assets in real estate which have been completed, that is, the construction is complete for that particular property, and also that has to be an income generating property. So that way a steady flow of income can be ensured for the unit holders. And obviously it's a very good idea for you to diversify your investments. So real estate as an asset class could be something that you can venture into. Maybe initially you can start considering investing around 10 to 15% of your total portfolio size, and you can think about starting an SIP in all the REITs that I mentioned earlier because they are the ones that are present now in India. And obviously REITs are SEBI regulated, so it's absolutely safe for you to invest in them. You can buy REIT just like any other equity shares of any other company by opening a Demat account with a broker and purchasing through them. If you want to know what happens behind the scenes when you start your investment journey, you can go ahead and click here. And if you want to know how you should calculate your portfolio return, you can go ahead and click here. That was it for this video, and until the next one, take care, see you, and bye-bye.